Welcome to Iron Vision Trading, Episode 2. Today, we're going to review my trades for the week ending July 10th, 2026. We had 10 trades this week, with a little bit of activity every day except for Tuesday. And real quick, you'll see that I do have my overlay in place, so now you can see the real live value for the account. We're going to use the net liquidation value to track our progress. The net liquidation number represents what my account value would be if we closed every single position and went to straight cash. Taking a look at our first trade, we actually closed out the gold trade that I had referenced in the last video. We were up over 50% profit, and we took that off for a $194 winner. But then a few days later, we had another pullback in gold, and so I sold the 69 put, and the very next day, gold recovered a bit, and I was able to take that off for a $75 winner, so we went ahead and did that. Next up is Walmart. The stock pulled back on the 6th, and we sold a put at 105, and just a couple days later, I was able to take another $75 out of that trade as well, and so we closed that out. That brings us to Procter & Gamble. Procter & Gamble has actually dropped a few dollars since our last video. We were really centered between our 140, 160 strikes before. You can see the stock price is now at about 147. So actually we just sold another put at 140. So now we've got two puts at 140 and a call at 160. We would still like to see the stock price get to about 150. The profit on those puts would come in nicely, and we'd still be pretty far away from that 160 strike. Again, with earnings coming up at the end of the month, I'm looking to get out of this position in the next week or so if I can, and then perhaps enter another strangle or something like that right there on the verge of earnings. So now we'll take a look at Intel. If you remember, I had a Jade Lizard in Intel, which was a short put below the stock price and a call spread above the stock price, so I had defined risk to the upside. And actually, we've seen a pretty significant pullback in Intel since our last video. That call spread started to dry up, so I went ahead and took off the short call. This may turn out to not be a great decision. We're going to have to wait and see. But my thought process was I could take that short call for a couple $100 and then lean long. So now the entire current position would benefit if we can get Intel to recover. Ideally, above that 115. If we don't get a big push, I would be risking losing that $186 left in that call. Now, as we're getting close to earnings again, this will be one that I'm going to be looking at very closely. I likely will be rolling this out to the next expiration cycle here within the next week or so, and potentially adjusting that put strike to maybe reduce some of my directional bias on the trade. But for now, we're leaning long, and we would love to see a big gap up in Intel over the next week or so. Next, we'll look at IonQ, and you can see I actually sold another put, this time at the 35 strike. As I mentioned in the other video, we needed IonQ above 40 for our existing put, but unfortunately we got a pretty big pullback last week, so I just went ahead and sold another put, this time at 35. We're leaning long on IonQ. And next we have Pepsi. Pepsi reported earnings on the 9th, so on Wednesday we put on a delta neutral strangle. We were looking to benefit from the volatility crush that usually comes after a binary event like earnings. As you see, after earnings, Pepsi actually gapped down to 135. It actually hit our short put strike. It's sort of stabilized now around 138, and we have a decision to make. We're at about 75% profit on the call, which means we're up $124. The maximum additional profit that we can extract from this call is 42 cents. That's 42 real dollars. This is where I think holding to squeeze out that additional profit actually adds risk to the trade. We're now risking giving back a pretty significant profit. So I'm really considering just taking the call off and leaning long on Pepsi, but there are other perspectives to consider. Some would just want to leave the call on and maintain that additional $42 in buffer in the event that Pepsi continues to slide. And another thought would be to roll the call down. That would just be buying back the 155 call and selling a 150 or 145 in the same expiration cycle. This would bring in additional credit. It would reduce some directional bias on the position. However, it does expose you to the whipsaw risk in the event that Pepsi would rally, and now you have less room between the two short strikes, and you could easily find yourself in a situation where now the call strike is being tested. Now, I think all of those perspectives have merit, but in this case, I do think I'll be looking to take off that call next week. And our final trade is another short put in Netflix. Netflix has been quite volatile over the last few weeks, and we had a few dollar pullback there on the 10th. So I just sold another put, leaning long, and if we get a bit of a recovery, then I'll likely be able to take that off early. And I'd like to do that because we're actually getting very close to earnings. So this is a little bit of a risky play. I really don't want to have that position on going into earnings because this next week is likely going to see a volatility increase. So ideally, next couple days, if we get a little bit of a lift in the price, I'll take this off. Then I do plan to put a trade on right before earnings, and that way I can capture the absolute maximum volatility increase and then hope for a volatility crush after earnings. Use that as a bit of a kicker toward my profit target and then just manage the trade as I normally would thereafter. All right, and that wraps up our trade review for the week. So let's take a look at a few positions that we have on. We won't look at the entire portfolio. Starting here with M&Q, we're up to about 30% of our profit target. So even with the recent pullback in M&Q, we're still trending in the right direction. We don't have anything to do here. Now, one thing you might notice about M&Q specifically, even though we are after normal hours, the prices keep bouncing around and you can see P&L's changing and mark prices changing. And that's because this is a futures contract and the futures have an expanded trading window. So actually, you can trade NASDAQ futures basically 24 hours a day and 5 days a week. The futures market closes at 5 p.m. Eastern on Friday and opens up again on Sunday evening at 6 p.m. Eastern. And so you'll see that throughout the week, even at night or whenever I'm making this video, the NASDAQ could be bouncing around. We'll quickly take a look at these EEM positions. And again, that top strangle is a follow for my wife's account. You can see we're up about 13%, so nothing to do here. We're nicely between the short strikes. And that bottom strangle, which is the old position, is actually coming in nicely because we are getting a bit of an uptick. So ideally, if EEM can get up between those two short strikes, this position is going to come in nicely and we'll take this off. And looking at this short put that we have in Nike, which is another follow trade for my wife's account, Nike's trended up $1 or $2 in the last week, and so we're up at about 21% right now. And I think that'll do it for this week's video. Please remember, I am not a financial advisor. These videos are for entertainment and educational purposes only, and I am not making any trade recommendations or guarantees of future gains or losses for any particular investment strategy. Thank you so much for watching. Y'all take care.